Hey guys, how are you? We're super glad that everyone is here. Let me check the studio and see how many people are here right now.
People. Looks like we got about 14 in here.
Nice. I don't know where that is. I don't know how you found that.
Down on the bottom right where it says people.
Oh, well, I've got a different screen. Thank you to everybody who's here right now. We're going to have a really fun episode today. And obviously, I'm Eric Bramlett with Bramlett Partners, and Max is with us.
Yeah, I'm Max, Leaman team, Lone People.
Today, Aaron Scruggs is with us. Aaron, would you like to go ahead and introduce yourself?
Hey, I'm Aaron Scruggs. I've been building out a market stats platform for the last year called Agent Intel. Been working close with Eric to mature that.
Awesome. We're going to get deep in the weeds on statistics today. There's obviously been, we've been in a down market for a while now, and this year started off a little bit sluggish. Then things in March started improving, and then beginning of April, we saw some economic, I don't know, turmoil is too strong of a word, but things shifted again. And yeah, there seems to be a lot of fear and uncertainty out there, and we hope to calm that a little bit, talk about what we see, talk about, the direction we see the market going in the near term, midterm, long term. Major components of the market, obviously, are going to be national components like mortgage rates, the broader economy. And then we have a lot of local components too. Those local components are, in my opinion, relevant to anybody, even if you're not in Austin. You can look at some of these same statistics, anywhere. You can look at it in freaking Omaha, Nebraska, and you're going to be able to determine what's going on with your market there. With that said, I think everybody is probably most interested in mortgage rates. And I think a lot of people don't necessarily understand how rates move, because there's times that we say broad things like, oh, when the Fed reduces rate, like you're ultimately going to see rates come down, but it's not directly tied to that. You hear things like, oh, when the stock market, bad news is good news. When the stock market tanks, you'll generally see mortgage rates go down. And that didn't happen this time. So that said, Max, you're the preeminent mortgage expert here. So what do you see? And yeah, the question on everybody is like, when are rates going to get back to 3%, buddy? Like, I need to know that. So
Right. Me and you both. My best guess is probably never.
okay.
Probably never. Look, we talk about it a lot. Typically mortgage rates follow treasuries, the 10-year treasury. You watch the yield. As the yield goes up, rates go up. As the yield goes down, rates go down. Typically in a normal environment, whenever that is, 2019 and before, basically, you have money moving from the stock market out of the stock market. Stocks fall, flight to quality, flight to safety, into bonds. Bond yields go down, prices up, and rates follow those bond yields down. Right. So that's generally what's happening. We started to see more of a correlation closer to that this year than we've seen in a while. I've been talking about this since February. I've said it online. I've said it in person. I very well could eat a lot of crow if I'm wrong about this. But, we've been seeing rates come down overall. The U.S. government has about $9 trillion worth of debt that has to be refinanced this year, and the majority of it by June. The current administration has made it very clear their mandate is lower interest rates. And they have specifically said the 10-year treasury. 10-year treasury gets rates down, it gets mortgages down, all of these things. Now, we do have the president, he'll shout out every now and then that he wants the Fed to lower their rate, but to lower the Fed rate and cut rates. But a lot of what needs to happen really can be done without the Fed cutting any rates. So first, we see all tariffs. They're on, they're off. What's going to happen? We don't know. A lot of turmoil, a lot of chaos. You look at the tech stocks, Nvidia specifically, down significantly this year, hit a high of 145. At one point yesterday, I think it fell to like 87 or $90, ended somewhere around $100. The S&P is well off its high, ended yesterday under 4,300. We saw the S&P come down right after Liberation Day and hit 5,000. So here's the thing, right? Like, everything's trucking along. I've been saying I think that rates will have a 5 handle on them by the end of June. 599 is a 5 handle, just so we're clear, and that's kind of what I'm looking at. When we look at the 10-year treasury, you can see we hit this high here back in January, back up 481. And I mean, we can take this much further back. We go back to October of 23, right when we were at 5%. But more recently, this was the high.
Right.
Now, I follow Logan Mohtashami a lot. He's the lead Housing Wire analyst. Very smart. There's a lot of people I follow. But when it comes to charts and rates and what's going to happen and what needs to happen, he is my most trusted source. Prior to Liberation Day, he was saying the 10-year yield, the right spot for it was about 4.35. When we look at Liberation Day here, April 2nd, yields were down here. Prior to that, April 1st, and then Monday, right here. The day started at 4.32. Yesterday, yields closed at 4.31. So the 2 weeks of craziness between what happened with everybody's getting tariffed, this is all happening. The reason that the markets freaked out was a couple. Tariffs are feared to be inflationary. And so we're slapping 20% tariffs, 60% tariffs, 80% tariffs on nations. So you saw the stock market really take a tumble. You did see on that Monday following that they leaked that there was going to be a pause on tariffs. Then on Wednesday, they came out and actually said there is going to be a pause for 90 days. The reason they leaked it is because they wanted to see how the market would react. And they've come out and said, this, it was a test. What's the market going to do? The only reason that they came out and paused it is because the market, there was a misstep, a miscalculation in what would happen. Great turmoil in the stock market, you're going to see a flight to quality, a flight to bonds, right? Which should bring yields down. But what did we see? Immediately following the next day, that Friday, we came down, we closed here, but then we gapped up on Monday and we saw yields shoot up 50 basis points in a couple of days. Why? China's dumping bonds, Japan's dumping treasuries, other nations dumping treasuries. The dollar, you can see here, the dollar's at extremely low point at 138 off a high here of about 110.
And sorry, so this is all due to a lack of confidence in the U.S. economy by other countries, or
that's exactly that.
Well, there's that, but then how much of this is also retaliatory from China? Do you think? Not that we're not going to a big political discussion, I guess, but
no, but China's definitely doing what they want to do. I actually, from what I've seen, and China's definitely trying to do retaliatory things, but they're kind of in a bad spot. What really started happening, I think, more than anything, was really Japan was unloading more treasuries. Japan's one of the largest holders of our debt.
Okay.
And so Japan was unloading a lot of treasuries at that time as well, more so than China. So I think that there's some China stuff in there, but I think it's just an overall lack of confidence initially in the U.S. economy, the U.S. dollar. That's always considered the worldwide flight to safety, right? We've seen the bond market stabilize. We're back down into our trends. When I was talking about 599 in February, we're here. This is about where yields were. So we're still about 20 basis points lower than where I started my whole theory. My theory being we have to get rates down because we have all this debt to refinance. How do you get rates down? You create turmoil in the stock market, get investors putting money in the bond market, right? You also, to have a full-on recession, you need unemployment sustained at 4.3% or higher. And so what's happening? Doge came in and started firing everybody, right? And so all of a sudden you're going to see, in my opinion, unemployment shoot up. I think by May and June, you'll start to see that number be 4.5, 4.6, 4.7. I think that's very feasible. For the current administration, they can claim that as a win because they can say, well, we're sorry unemployment's higher, but most of the new unemployment numbers are from government jobs that we cut that shouldn't have ever been around in the first place. So it's not my fault. I just did what needed to be done. So the administration can still claim a victory, so to speak, along those lines, right? There's a lot. Bond market does not like uncertainty, and there certainly has been a lot of uncertainty. And there's been some miscommunication clearly within the White House and the administration as to who's doing what, when, and where, and what's tariffed, and how's it tariffed, and is it classified as this, is it not? Coming back, now we're not going to tariff phones and chips and things like that. So who knows where this all really lands? What I think will happen, I think, as part of his tariff negotiations, he's trying to box out other countries from doing business with China completely and letting China run through their ports. I think there's a scenario where he also convinces them to start buying our debt. There was a great article that came out yesterday from the Jeffries Economist that talked about the tariff twist. What is the tariff twist? Sorry, the Treasury twist. The Fed said this week they are not going to help the stock market. And that's why you saw the stock market fall this week and bonds have started coming back down, because when Powell got up to talk, he's like, yeah, like we're not cutting rates. We're not helping the stock market. We're afraid of inflation and higher unemployment and lack of growth. So they're not doing that. This is why you have the president screaming he should cut rates, he should be fired, all of these things. What the Treasury Department can do is they can start buying short-term debt and replacing long-term debt with short-term debt.
Is that just EQ? I'm sorry, is that QE or is that something different?
It's not QE, but it effectively has the same result as
Yeah.
QE. You're not the Fed is not increasing their balance sheet. The Fed's not printing money. The Treasury is just swapping out debt. So you can bring down rates on the longer end of the yield curve. And look, I'm not an economist by any stretch. And I've even put this, like I read this article 3 times and then I put it in Grok and said, tell me this like I'm a 12-year-old.
Right.
But I mean, the Treasury has a lot more tools in its tool belt than the Fed does. The Fed has essentially one tool, and it's rates. Cut them or raise them. That's all they can do.
I thought the Fed was in charge of QE as well. Is that not the case? Is that the Treasury?
No, the Fed is. Yeah.
Okay. The Fed can cut rates and they can QE, and then the Treasury effectively has this other tool that
the Treasury can still say we're going to buy.
And the executive branch, so the presidency has direct influence over the Treasury. Is that correct, or where are we there?
Yes. As best as I understand it, yes. But the Fed specifically is about monetary policy.
Right.
And going about it this way kind of circumvents monetary policy because all they're doing is swapping debt.
Got it.
So it's pretty genius in a way. When
would you say it's 4D chess, Max? Would you say it's 4D chess?
It is definitely 4D chess. For sure. But, you know, we know rates have to come down. And one thing that I think that I don't care if you're a Republican, a Democrat, you voted for Trump, you didn't vote for Trump, you love him, you hate him, it doesn't matter. I think one thing that is just a fact is he cares about himself and his worth and his family. I mean, as evidenced by he did not put his businesses in a blind trust. He's clearly still involved. And how does he make his money? How is he a billionaire, right? Real estate.
And meme coins. Don't forget meme coins.
That. But what makes real estate more valuable? Lower rates. So among everything else that needs to happen, it benefits him and his family the same. So you put all of this stuff together, and it just tells me that rates are going to be lower. And when you look at this chart, and we've seen it a million times, rates can come down quick, and then then they get, stabilized. And then they can come down quick, and then you have violent moves down and you have violent moves up. So we're roughly 75 days away from my prediction. That's a long time. And when you look at this, and I've shown this before too, let me put this up here. This is the spread between the 10-year Treasury and the 30-year fixed rate over time since about 1970, right? The general is about 2% to 1.5%, 1.75%, kind of in that range. We see some spikes and some down, and obviously since this was right at COVID, and then here we are, and then 22, 23 and on, we're living up in this 2.5%, 2.75% world.
So did you switch your screen?
Go ahead. I'm sorry.
But you can't.
Max, did you switch your screen? I'm not sure.
I did, and I didn't. I thought I had the whole window on here. Hold on. Let me pull this back up. Sorry. There we go.
Yeah.
So you can see, again, sorry about that, but 1970s, we're really rocking under 2% except for some periods of time. Right at the beginning of COVID here. This is when rates were,
It's when times were party times, when that was.
That's right. And then we get into 22 and 23 and 24, and we're rocking through here. So, I mean, spreads are now about 2.5 to 2.75. Point being, you have a 2.5 point spread and the yield's at 3.5. Your rate's at 6, 5.99, right? And we've seen how fast these things can move. I'm not doing a good job. I thought I had that figured out. We've seen how fast these things can move, and so it's just not. I'm not nervous. I'm not scared. I'm not concerned. I think this is just all how it's going to play out.
So I know we talked about it. So okay, to summarize, when I hear all of this, I'm very happy that you understand the inner workings of why the rates are doing what they're doing. My 12-year-old brain goes, okay, great. Like, sounds like rates are probably not going to get worse. Sounds like everything sort of freaked out, after the initial tariff announcement, and we should probably see rates in a slow decline from there. It would, and we've been surprised by a lot of things, so we could certainly be surprised and they go the other direction for some reason. But the likeliest scenario is that we're going to see rates stay around where they are and go down a little bit. Whenever we planned this podcast, I know we were going to initially talk about local market next, but I think this sort of tees up the sort of macro a little bit better before we dive into the local. So Aaron, if you don't mind, I just want to share a couple of things like really, really quickly.
No, please do.
Yeah. So we've talked about fear and uncertainty, right? Which that's really what drives markets, like the overall sentiment of, do people think things are good? Do they think things are bad? Human beings in general don't like uncertainty, and uncertainty and fear are very close together. And so that's been the big change, right? Like, we had kind of okay consumer confidence in January, February, with not great rates. Like, rates were north of 7%. With the stock market doing fine, like everybody's 401k looked okay. Then we had March hit, and all of a sudden, the rates went below 7%. Contracts actually ticked up. It was great to see, because we'd had a bad, we had bad units sold in the month of March. So things were looking up, and then we had all of a sudden, got slapped with a curveball, and that's when the tariff news hit, and everything, in my opinion, reacted more strongly than I assumed it would react. Did you guys feel the same way?
Yeah, I mean, I think, and you saw it on that chart too, right? Just between what the treasuries have done and what stocks have done.
Right. And so, I follow a couple of things pretty closely. I'm going to share my entire screen really quickly. So, this is consumer confidence, and I follow the United States Michigan consumer sentiment because they tend to update it more often. They've already updated for April, which is great. And you can see, I mean, gosh, guys, I mean, it's just a straight line. It's just a straight line down. And in March, it wasn't great. And then, like, oh, how can it get worse? Well, it can get worse by announcing a freaking trade war. There's another gauge I look at. It's the fear and greed dial that CNN puts out. And this sounds really crazy. It's like, extreme fear, extreme greed. It's from the famous Warren Buffett quote: "You want to be fearful when others are greedy, and greedy when others are fearful." And that's why they labeled it the way they did. The market has been in extreme fear since the tariff announcement. It has not ticked up to just plain old fear. And if you look at what's happened with it since January, it follows the consumer sentiment pretty exactly. And that makes a lot of sense, because most people confuse the broader economy with the stock market. Most people think, like, oh, the stock market's doing great, the economy's doing great. Not necessarily true, but when people believe that, the stock market's performance really affects consumer confidence. And how that translates to the real estate market is, when people think times are good, they're braver, right? They're going to go out and buy a house because they feel like things are good. And when people are fearful, they won't, right? Like, if they think things are shaky, they're afraid of their job, they're afraid of their 401k, things like that, they kind of pull back. And so that's been the macroeconomic change, is just simply that consumer confidence has really gone downhill since then. So where we are now with it is that it looks like rates are around where they were in March, but now we have kind of this, consumer sentiment that has degraded. That's what I see at the national level. So, Aaron, do you want to kind of share?
Dramatic pause.
I mean, well, if anybody else had anything to say, but
no, I mean, look,
Yeah.
I was kind of waiting on Aaron to maybe say something, but I mean, I think I agree. And you see, just even on that sentiment chart, how fast things change, right? I mean, think about even last year, we were talking about there was going to be 6 rate cuts. Then it was 3. Then we're coming in, okay, now there's not going to be any this year. Now there's going to be 2. Now there's going to be 3. What's going to happen in May? Like, nobody knows. And I mean, frankly, when you talk about all of that stuff, the Fed is always too slow to move. And now we're hearing things like transitory again. So is that good or
Seriously,
bad?
with CPI or what?
No, with tariff inflation is transitory. So is it? I don't know. He has said those words. They've also basically started to say, stagflation is a real concern. But the one thing when I heard that, I thought, oh great, we actually don't have to worry about stagflation because the Fed seems to be wrong all the time. So who knows? But like all of this factors into consumer sentiment, extreme fear, extreme greed, all of those things play into it, and it all just changes on a dime.
At the end of the day, people want to feel safe. You want to feel secure in your economy. You want to feel secure in your job. That's why people buy houses, right? Because through the nesting instinct, I'm going to be here for 5 to 10 years. And I think right now, we have just an overall environment that is anything but stable, right? Things feel very uncertain. Why is real estate moving at all? And we'll get into those numbers in a second. I was really surprised to see that the pending units for the first half of April were only down by 2.5%. I was like, why? And I talked to Aaron about it, and he pointed out some other things to look at, and we'll talk about those in a minute. But I think that people are still buying and selling because we have 3 years of pent-up demand right now.
Mm-hmm.
You have people that have wanted to buy and sell for 3 years. Their house is too small for them. They are sick of it. Their house is way too big for them. They are sick of it. And so that's why they're willing to like sort of wade into this uncertain market. All that said, Aaron, so to sort of set this story up, Aaron and I were in Boulder last week. We were at a mastermind event there, and he looked at me and said, "Hey man, guess how many price reductions there were in the month of March?" And I said, "I don't know. I'm excited. Tell me." So tell us, Aaron. Share your screen. Talk about what you got.
Yeah, absolutely. So the reason why I never have much to comment about on like national news is that whether things are good or bad, it's always depressing. So I usually just ignore it. And unfortunately, at the Austin level, there's some not great trends. Something really stood out, and I'm going to share my screen here when I was looking at what was going on last month. Can y'all see my screen all right?
Yeah, for sure.
So here we're just looking at residential Austin Metro, the number of price reductions. So there were, a little over 11,000 active listings, 3,000 price reductions, 27%. That felt a little alarming to me, but you need to look at all this stuff inside of some level of historical context. And that's when things really stuck out.
Didn't get any better.
Yeah. In fact, this is why, like, never really thought I would be the alarmist on a podcast, but here we are. Last year, this time, there were just 1,400, which means last month we saw twice the number of price reductions in the market. So, Eric, as you were digging in and looking at the number of pendings just this month, my hypothesis, and I think we'll see this hold true, is that they were significantly artificially inflated. Buyer activity was artificially inflated because of the number of price reductions. You can't maintain this trend on price reductions month over month.
Well, okay. I mean, I agree with you that you can't have that on a month over month basis, but and this is pure speculation. But if you go back to, we have 3 years of pent up demand. And what I hear a lot anecdotally from agents is that sellers this year are more receptive to good advice than they were in years past, because we're now on year 3 of like, hey, we're kind of in this bad market. So I'm curious if, like, okay, try not to get too into the weeds on this. New listings are one of the earliest indications of demand that we have like concrete evidence of. And the reason why new listings are evidence of demand is those are people that want to move. They're going to live somewhere by and large. Like we don't, there's a small percentage like probate or whatever. Most of them are going to stay within Austin. And so you look at that and you say, these are people that want to sell and want to buy. In the past, we had a really high failure rate. I think last year the failure rate was like 35% of listings that were listed just expired or withdrew. So perhaps this is me with rose-colored glasses, I guess. Perhaps sellers are becoming more realistic, and they're going to meet those buyers who have been on the fence by reducing price. Agreed, you can't continue to reduce price on a month over month basis, but I'll show you some of the numbers when I looked at the pendings in April. in what we saw, like what the list price was on those versus the previous year. Now with
Play devil's advocate,
go for it.
and I'm going to be the sky is falling person for this rare moment in my life, and that is, yes, typically new listings are a strong, agreed, a strong indicator that you're about to see more buyer demand as well. But when we went through the boom and the good times, there appeared to be a whole lot of investor activity. A substantial amount was more investor activity that could just as easily translate to just people looking to liquidate a portfolio.
I will Mike Del Prete you on this one.
Yeah.
We don't know until we actually that anecdotally you're correct. There was a lot. There's a lot in the news over it, right? BlackRock is buying all the houses. Investors are buying all the houses. I don't think that it was as significant as it felt.
I disagree with you on that.
Here's what I would say to that. We are all speaking in anecdotes unless we actually look at the data, and it's really tough to get that data because you have to cross-reference. You have to cross-reference with tax data, and then you have to make a lot of assumptions. Sorry, what are you going to say?
Well, just from a mortgage perspective, I could probably pull this relatively easy.
Do it. Yeah.
Everybody was buying investment properties. I mean, everybody. It was easy to cash flow. Rents were up. You could get a rental property with a 3% rate. I mean, how many properties did you buy? I bought some.
I bought one. I refied a bunch.
You refied a bunch, but there was a lot. Like, we have some friends that bought 2 or 3. There was a lot of people buying rental properties, more so than I had seen before. And if you look now, you can't put 25% down in cash flow. You're going to be negative.
Well, let me play angel's advocate to your devil. So
I like how I'm in the middle of you.
Can we call it wolf? Can we have like multiple wolves here? Because I love that one way better. Yeah, man, there was heavy demand all over the place. You know what I mean? There was massive FOMO in the environment. Like, everybody wanted to buy a house in Austin, to move here for a second home, for an investment, whatever. Max, I didn't even think about looking at mortgage, but yeah, if you can crunch that data. Like,
see if I can. I'm going to see if I can do it while we're on.
Well, don't do it. I mean, if you can do it now, great. But I'd love to talk with you. But yeah, I'd love you. You have a large enough data set to be very statistically significant. It would be really interesting to see what the investor volume was in 2021 versus 2019. Mm-hmm. I think that would tell us a whole lot if we looked at that. Anyways, Aaron, sorry, I hijacked the whole thing. What other statistics?
Yeah. So I'm gonna just throw out one more thing to continue to play that devil's advocate. And Max, thanks for having my back on this.
Screw you, Eric.
The Gang Up on Eric podcast.
That's right.
Demand has been below historic averages.
Agreed.
For the last 13 months. Supply has been significantly above historic averages. Now, even if we take all those new listings and all of them are buyers, it's still not going to crank things back enough. Not to mention, just as prices went up and up and up in 2021 because they started going up, and their sentiment drives a whole lot of the market. In the climate we're in, it's not unreasonable to expect, when you see such a significant amount of price reductions occur, that those sellers are going to be looking for deals. All the other listings that are out there are going to need to adjust down, and that we could very well be in we could be seeing the beginning. I hate being this alarmist. This race to the bottom.
Disagree that it'll turn into a race to the bottom, because I think there's a floor. If you talked, and this is purely anecdotal, so I guess Mike Del Prete me and tell me that I'm full of shit. It's whenever you talk to sellers, whenever you can have a true, honest conversation with them, you say, look, what's your floor this year? And then you can help them strategize to try to get that. Most sellers will have a dollar at which they will not go lower than, and they will either rent the property out, they'll stay in it, and some of them talked about just letting them sit vacant. So I'm with you. I do think, and if you don't mind, I'll share a screen in a second. I do think that we are in the early stages of watching a price dip. I don't know that it becomes severe. I don't know that it becomes double digit. In 2008, the 2008 to 2012 recession, you had banks liquidating properties en masse, right? We had massive short sales, massive foreclosures. People just walked away strategically. That's not happening here. It is certainly, times are tougher. Certainly there are some layoffs, but it's not a 2008 scenario where where we saw things just chop until they were sold. We have that floor at which point a seller becomes a failed seller rather than take too deep of a cut.
So I would say we're actually in agreement on that, and the bottom is the floor.
Yes.
No basements here.
Yeah. Let me share my screen really quickly, and then I'll pass it back to you. So one thing, and I'll be, I'll put that devil on my shoulder and let him speak for a second. What really concerned me whenever you told me, hey, we had all these price reductions, was I said, that's March. Like, what caused it? I still can't explain it, because the tariff, I'm calling it the tariff turmoil now, by the way, it's alliterative. The tariff turmoil started in April. And so when Aaron told me and showed me like, hey, we have all these price drops, I was like, well, that doesn't make any sense, because if anything, the news was becoming more positive in March. And so I looked at pending units, and my chart is not going to be anywhere nearly as pretty as Aaron's, because it's just a spreadsheet. But here we go. And when you look at this, this shows you what happened in the month of April, the first half of April, for pending units. So here's the good news. The good news is that pending units only declined by 2.5%. Aaron, I did adjust this based on settled data. So this does include an adjustment for that predictive. So 2.5% drop on pending units in the month of April. That's phenomenal news. Well, okay, what about those listings? Well, the average list price of the listings that went under contract was 6.5% lower than the previous periods. April, 2024, they were priced 6.5% higher. Median was priced 5.5% higher in the month of 2020. It's all around this 5% range, like call it 5 to 7% range. So what I think that we are teed up, because pendings are a leading indicator of closings. I think we're teed up to probably see a 5 to 7% price drop whenever the month of April shakes out and we have that data. That's what I have.
I have a question about all of this. When you talk about the number of price reductions, I'm curious, do you see a trend of like how many price reductions until there's a sale? And then what is the final difference percentage wise of sale price to list price after the final price reduction? I asked this because I heard recently, I was doing a presentation and someone said that if you home priced correctly, will sell in 17 days.
That's a made up statistic.
The average CD, the CDM. Well, so I don't know, but I'm just asking. Like, so if you look at
how do you define home price correctly, and how do you do that?
Well, so that's what I'm asking. So like, if that,
because when you define it, homes that sell in less than 20 days are priced correctly. So then you take that data set and you say, oh, the average is 17 days, right? I mean,
then that may be. This is why, like, this isn't my area of expertise, but I wonder when you're talking to sellers and you're saying, okay, look, here's the average price reduction. And once you get your last price reduction, now the home sells in X amount of days and you're getting X amount percentage of that final price reduction. Is that like, have y'all looked at those numbers? And is that something that can be used to go back to sellers and say, look, this is what it's going to take. This is where the home needs to be priced. If you price it here, you likely won't have any price reductions and you'll likely sell in X amount of time, versus if you start here, we may have to be on the market for more days, more price reductions, yada, yada, yada. Like, is that?
Well, Aaron, do you want to speak to like the statistical issues with stuff like that? Or
when it comes to, I'll get us started and you keep us rolling. When it comes, so one of the problems is that when it comes to the, the close price, is that's more of a lagging indicator.
Yeah.
Because those are typically, those are the price reductions that happened at least 30 days before that date. And that's why we're more focused on pending. The other challenge there is that it's far more than pricing, that pricing right affects the outcomes.
So yeah,
thinking for sure.
My problem with it is if you're looking at it from a pure statistical analysis, like you have to define, Max, what does it mean to price correctly, right? And I was being a smart ass whenever I said if it sells in less than 20 days and it was priced correctly, but that is one way to define it. If you defined it as that, then the days on market are meaningless at that point. So you say, okay, how else could we define it? Well, you could look at like automatic valuations, but we all know how accurate those are. It is an unknowable statistic that sounds really good in a listing presentation if you have somebody that doesn't know how to do math very well as the seller. So that's something that, like the whole stat of like 93% of all statistics online are made up, right? That's where I would throw that statistic into. Now, that said, where you're going with this is from a very good place. And that's like, how do you advise sellers? And unfortunately, it's as simple as this. Like, here's the range. Like, you find some great comps, generally 5 or so comps when you can. And you say, here's the range of these comps. This is the range of where we could price it. We're in a declining market. If you price it on the high side of these comps, you have a higher likelihood that you will not sell this year. It's as simple as that. If you price it in the middle, you probably will still sell, but maybe not. If you price it on the low end, you're pricing it ahead of the market. That's generally where you want to be. And unfortunately, right now is one of those times that when you advise to price ahead of the market, I would posit this. Would you agree that it's always a good idea to price ahead of the market, Aaron?
Yes. We just need to qualify that there can be very different markets.
There can.
Actually, qualified, yes, because back in 2021, you would generally do a better job to price where the market is and let that bidding war play out than try to price to where the market was going to be the next month.
Well, you couldn't price it 40% ahead, but if you had a bunch of sold comps that were at, round numbers at 500,000, and then you had a bunch of pending comps that were listed at 525, you knew you could probably list at 525 or 535 and you would still have multiple offers. I mean, hell, talking about 2021, you could list it wherever you wanted to and you're probably gonna have multiple offers. But in a normally appreciating market in the springtime, you can always price it a little bit higher than the most recent solds and you will still get play. In a completely flat market, pricing ahead of the market simply means pricing with the comps, right? This recently sold, we price it there, we're pricing ahead of the market. Unfortunately, this is when our job is not a lot of fun. We always need, in my opinion, to advise sellers to price ahead of the market. That's seasonal, that's market conditions, that's everything. And whenever you are in a declining market, your job is not a lot of fun. You are giving bad news if you're giving good advice. And right now, pricing ahead of the market is here where the most recent sold comps are. The pendings are 7% lower. We need to price it with the pendings, not with the recent sold comps, and perhaps maybe even a little bit lower than the pendings just to get out in front of everything. That's the advice I would give.
So the one I feel like thing that you're really missing, and I'm curious why you're not speaking to it, because I know you're very thoughtful on these things. When it comes to pricing in reference to the competition, that looking at what's sold is certainly helpful for what it might appraise for. Looking at pendings is helpful to say, hey, here's what's getting some activity now. But when it comes to pricing, you've got to look at what the buyer's other choices are.
Well, no, for sure. And I'm overgeneralizing and oversimplifying, and I'd like to dig into that in a minute also, and we'll talk about hyper local markets. Yes, certainly. You effectively have 4 data points. You have sold, pending, active, and withdrawn. Active are properties that have not yet sold that are available to purchase, and you need to bear that in mind. So after you've looked at your solds and your pendings and you have developed a strategy based on that, you then check it with what are the current actives. These properties have not yet sold. If we have a bunch that are priced higher, that doesn't mean we should go higher. But we certainly, if we have some that are priced lower than what we're considering and they're not selling, that needs to be taken into consideration. And that's just smart. In my opinion, that's smart. Smart pricing. And that's the reason why, everybody loves this line. It's the reason why Zillow couldn't get it right whenever they bought it, lost $1 billion on their automatic purchases or whatnot. You can't really plug this into, I used to say algorithm. You can't even plug it into an LLM and get the right price back, because it's more of an overall strategy and you have to really take into account a lot of nuance.
Yeah. I enjoyed, maybe not enjoyed, but I found it effective to take the active listings and say, here's what's not selling.
Correct.
And I think that's a lot of what agents are going to need to, should be considering in their listing presentations right now.
And I know, and that I've become a massive fan recently of seller success rate, where when you show them, 78704 right now has a 49% seller success rate for the past 12 months. That means that 51% of sellers that hit the market in 04 don't sell. And a lot of times what agents will do is they'll show a timeline chart of your sold to original list price. Max, you'd ask this. Sold to original list price will show you very accurately that the longer you are on the market, the lower you will sell as a function of your original list price. But what that tells a seller whenever you present that to them is simply that I will sell this property. It just might be at a lower percentage of the original list. That's not the consequence of a bad pricing strategy. The consequence of a bad pricing strategy, you don't sell the house this year. And that's what has to be communicated. And that doesn't mean that everyone should price their homes ahead of the market and low and whatnot. Some people don't need to sell this year. Some people say that's fine. If I only have a 50% chance, I'm going to price it with the comps. I'm okay with that. Keep extrapolating on this, like then it becomes a business decision for the agent. Like, do I want this to be an 18-month relationship or not? That's something that you have to decide.
Okay.
All right. Sorry, I'm not trying to. I think we just came to quorum or something. I don't know.
So you were talking about, we've been talking a bit about this depends on local submarkets. I would love to take a few minutes and just point out a bit of what's going on in those submarkets and why what we're talking about Austin writ large, sure, it will affect all the submarkets, but I would be approaching a listing in Mueller entirely different than East Riverside. Would now be a good time to start exploring that, or was there more to speak?
No, I thought you were about to share screen. I think what you're saying is that one size fits all doesn't make a lot of sense when it comes to real estate. Is that fair?
Yes. Yes, very much so. So I've been also just looking at what's been going on in the different neighborhoods. And as an example of just agents as you're going in and selling into different markets, that this approach of what getting ahead of the market means something very different. I'm going to talk about Mueller. Right now we're looking at appreciation rates over the last year, 12 months. Mueller is down 8% in appreciation, and it's this dark blue over here. That said, months of inventory is at 3. We are almost in a buyer's market. And pointing that out, like if you are going into a listing presentation in this market, I'd be looking at the comps. I don't think that there is a need to necessarily get ahead of the market, that there is still strong buyer demand. And in fact, when we look at months of inventory, Mueller here lit up as it's one of the places where we are seeing the strongest buyer demand right now, as judged by months of inventory. And I mentioned, hey, let's compare this to another market. This dark blue down here is East Riverside. It's right now sitting on 9 months of inventory, and it had a meteoric rise in appreciation over the last year. Looking into that, what appears happened is that it got flooded rather recently with some rather higher end listings. Right now, if you're going in there and you're trying to sell something at a premium, you're going to need to get way ahead of the market. As man, I feel for any flips going on in that market or any new construction as
well, and you can see, and when you click between the two, it looked like Mueller was around, sales price. Yeah, it was only 1.8% below the asking price. And then Riverside looked like it was about 5% below asking price, or 4.5%. There we go. Yeah. So yeah, you can see that there's a direct correlation between the months of inventory and where the seller ends up.
And just wanted to speak to this to just say, like, hey, as we're talking about these big macro trends and I'm all doom and gloom for what might happen in Austin, it doesn't mean that's what's going to happen in your neighborhood. Or
can you do me a favor, because I'd like to illustrate something else, and I know your tool can do it. Could you do a market real quick of like, can I feed you like 3 zip codes to see what the market looks like overall in that? And then I want to compare it with, I was going to see if you could use your market report tool over there. Yeah. So go, just create a new market.
What zip code?
Do 0331 and 0331 and 57. Add those 3 together.
Combining the 3 of them?
Yeah, combine the 3 of them. Yeah.
All right. You said 01?
No, 31. 1's its own beast.
Yeah. 31.
And then 57. And then just look at the results and see what. So I wanted to look at, okay, so you've got 6.5 months of inventory. You can see over here, this is like Central West kind of demand. Everything's fine, kind of. It's not awesome. And then scroll down a little bit and let's just kind of look at the high level stuff. Keep going. Yeah. So like, if you look at 6.5 months of inventory versus the year before, 4.5, pending listings haven't declined very much. You're at like 88 versus 98. Price reductions are doing what they're doing.
10% drop.
Yes, it is. I guess that's significant. Uh, but okay, so now go back up
Well,
and
let's just point out price reductions in this area are, they're close to 2x.
there exactly. But here's my point. Now go back and do the same market, but do a price. So create another market, and we have 6.5 months inventory there. Do 3.1, 0.3, and then 5.7. Okay. Now go to your price component below. Do 2 to 5 million, and then see what see what it looks like.
So we are getting into a very slim market here and skirting on the edge. It's still strong enough to draw some conclusions, but because we're not as broad, like we need to be just a little bit more careful with drawing.
Well, what I wanted to show is that we did this the other day, and you go from 6.5 months of inventory to 9.7 months of inventory. So the inventory increases by 50%. If you scroll down, I think that you can, drawing conclusions from like pricing and whatnot is tough. Pending listings, actually, some of the numbers don't look super bad. And I think that's kind of because it's a small data set.
Well, and so when it comes to pending and price reductions, what I'm seeing is that the luxury market is really not responding at the same speed as the market writ large.
Got it. I guess the point is that you have these geographic submarkets that are important to differentiate from the broader market. And then you also have pricing submarkets where you can be in the same area of town. And if you have something that's an entry level price, it's gonna behave very differently than if you have something that is luxury, right? It behave differently, something that is in a luxury price point and is a resale home versus luxury price point and new construction. I know for a fact that the new construction inventory is close to zero right now because builders stopped building about 2 years ago, but they were completing their projects. That was I wanted to illustrate that point. Thank you for letting me like drive for a second. And to plug for your tool, it allows me to really go in and satisfy curiosity and maybe win some arguments. Not that I like to do that very often. Yeah. What else did you want to show, Aaron?
Those were the main points that I had. We could certainly like weave through a whole lot, but it's really, at a high level, there is a possible leading indicator of unfortunate times. That doesn't necessarily mean that wherever you specialize in is going to be impacted as significantly.
Question on that chart you had demand line on there. How are you determining that? How are you figuring out demand?
The number of pending listings per month. The best indicator of demand is the number of things going pending, and the best indicator of number of supplies is the number of active listings.
So I don't know the answer to this. I'm curious. I think that, volume sold is an indication of demand as well. What's your take on that? I mean, it's a broad, I know that you look at market. I tend to look at market-wide volume sold, but how do you interpret volume sold in terms of?
Are you talking about the total value or units?
Both. Total value, I think I think it's a better, if you wanted to look at one metric, I think it's a better number because it shows you like the actual dollar amount people are willing to spend on real estate at any given time.
Yeah, so when it comes to units sold, valuable to know, it's a bit more of a lagging indicator. There's a more or less a consistent amount of pending listings that fall out of contract. So pending listings, in my opinion, is a leading indicator that sufficiently tells that tale. When it comes to the overall price point, the volume.
Do you like this image that I made with ChatGPT? I shared it at an office meeting the other day. Lagging indicators are like driving while looking in the rearview mirror. I think I need to send this to Jerome Powell and let him know of that concept.
And so to that point, sales volume, it can point to, hey, you've got more buyers and their price point is going up. It could be either one of those. That said, it's also going to be a lagging indicator. And that's why I think looking at pendings, looking at price reductions, these things that are happening in real time, and you don't have to wait on the agent to report. By the way, if you're curious why all the stats that come out from all of us, we wait till about the middle of the month, it's not because it takes a lot of work to crunch them. It's because agents, let's just say, aren't always doing that the day the closing occurs. And you really need at least 10 days to get a solid bead on what happened last month.
Yeah, and to defend the fact that we pushed them out a little bit early, we've looked at historical statistics, and we know that we can adjust, we can make assumptions whenever we generally will run ours on the 5th or the 6th of the month, and we know the adjustments we can make. Generally with sold units and pending units are the two you have to adjust a whole lot. And what Aaron's referring to is you turned me onto the term settled data, and it just takes a bit for the data to settle, and that's why it takes, that's why ABOR releases the middle of the month, because they're just waiting on the data to settle.
So I did a bit of can we digress real quickly?
I'm fine with it.
But when it comes to just the accuracy of this data, I dug into that, and this is how you're able to get ahead of it, is that on day 0, the day a closing happens, 31% of agents report the closing. Now, by day 5, you've got 80%. And with that, you have enough to make assumptions about the next 20%. Okay.
Go ahead. No, go ahead. I was making it.
And so day 15, you're at 93. And so that is where, the data can evolve over time, and why I think you are really smart to look at this and do some predictive analytics on it.
I was just going to say that I'm going to send you a t-shirt with this on the front, and the back is going to say, I'm a effing nerd. And no, I love it. I love it that you were that curious that you charted this. It's really good.
I will wear it with pride. I mean, it matters when it comes to having agents talking to their clients and prospects armed with stats.
Well, and what I love about it, I mean, like in the same way that I like to, talk smack and say, well, that's a made up statistic. Like anytime you can like show the numbers and show that you've actually crunched them, it shows you care a lot, and it shows that you're not just making assumptions and just making things up. I think it looks like we've got only a few more minutes for the hour, but I'd love to chat for just a minute. I mean, Max, like business planning, what do you do? I mean, business strategy, does anything change? What do you do? Like, let's maybe like the three of us talk for a minute apiece on what this means in terms of business planning.
I mean, I think, we always plan for what we think's going to happen, and then we have contingencies for it gets a lot busier and it gets a lot slower, so we're slow to hire to the extent that, I'm looking at the overall company pipeline and it's getting busier and turn times are up just a little bit. Typically underwriting is 24 to 48 hours. In the last couple of days, it's been closer to about 72 hours. So, we'll have underwriters work overtime and weekends and get that worked through, but it doesn't mean that we're going to go hire a whole bunch of underwriters right now, because I'm still seeing, okay, like last week was a really bad lock week, but this week on a short week, mind you, because the markets are closed today, was a fairly good, not great, but good lock week. So we kind of look at that, from my perspective, we have a lot of people cross-trained to do different things and work in multiple departments. We pull resources from a processing perspective. We have corporate processors. We will have branches use other branches processors, and we really try to use that before we decide, okay, we're definitely going out to make a hire. With that said, as you're recruiting and just trying to add to the sales force, you have to accommodate for that as well. So are we targeting loan officers? Are we talking to loan officers that are coming on with ops staff, or do we need to supply the ops staff kind of thing? But we're forecasting every month and we're evolving every month. So from a company perspective, it's almost like a month to month. What are we seeing? What is everybody's capacity? Who's doing what, when, and where, to figure out what that looks like. And what do we have as far as new growth from a loan officer perspective in the pipeline? From a more local perspective, because not only am I running this company, but I'm also running Leaman team as well. We use a lot of your data. When I'm running a company we're licensed in like 13 states, and we have 5 or 6 branches in Texas and one in Florida, and looking at some others. So, it's not everybody has an Eric and an Aaron to really be hyper local on that market. But from a Leaman team perspective, we use a lot of that data to figure out, okay, what does this look like? How is what we're seeing matching up? How is what we're seeing in the marketplace matching up with what we're seeing from an apps and locks perspective? And try to, we just plan and adjust from there. I came into this year thinking this year was going to be not great, but better than last year. right now, I really don't know. January was dead even. March was a little bit better. April's going to be a little bit better, but February was awful.
Awful. So was
Like
January.
50% worse than last February. So you get through the first quarter, we're down Q1 over Q1 this year versus Q1 last year. But if the way rates play out and we end up with rates in the high fives, and for that matter, when the average rate is about 6 1/8, 6 1/4, somewhere in there, you're getting rates in the fives anyway. But when that average rate is got a 5.99 on it or better, I just very much believe that's going to be a catalyst. It's not going to be raining money from the sky, but we will see a big pickup. And on the loan side, we'll see a pickup in refis. And it's interesting because I tell my guys, I preach this daily: be talking to your past clients in your database and have a strike price, what we call a strike rate, ready, because I've seen it at least 2 times back in September, and then during Liberation Day, where you have 2, maybe 3 days of rates falling to a point that it now makes sense for customers to refinance. So if you can be ahead of that and get ready to jump on that, because they can turn in 2 or 3 days and then the opportunity's gone. And now if you missed the boat in September and you missed the boat in December, and now you missed the boat here, it could be September again before it makes sense. Who knows? So, those are kind of the things that we look at and what we do to prepare.
Aaron, what are your thoughts? I know you're in a kind of a different position. I mean, bootstrapping a startup. I mean,
Idiot. That sucks.
no, I mean, to be honest, like
I'm kidding.
if you can bootstrap through this, then you're pretty much guaranteed success, I would say.
Well, in tighter markets is when brokerages and agents you don't deal with as many unsuccessful agents because they don't survive. And they're looking for ways I'm obviously going to put a positive spin on this, but they're looking for ways to generate more business. You're not going to do the sales pitch, but all these pretty stats are all designed around ways to convert prospects to clients. So I'm another startup trade. I am naively optimistic about, going into this market, as there are specific tools to help agents with their, with listings and having those conversations around price negotiations and around price adjustments. What I would offer is, are you going to be speaking to what agents should be doing? 'Cause if not,
I'll speak to that if you like. I mean, that's what I talk about constantly. But what I was going to tell you, during like the drunk money times, right, where anybody could raise money for anything, there were a lot of like aspirational products that were being developed, right? And that's a nice way of saying things that were really nice looking, looked really cool, but didn't do a lot in terms of solving any problems. And I think that whenever times get tougher, people really look and say like, okay, is this going to solve a problem for me? That's what I'm going to pay for. I'm not going to pay for something that just is shiny. And I mean, a plug for you, like this is a tool that an agent can drill into any given submarket based on any number of criteria and get insights really quickly on how to advise sellers and how to advise buyers. So I mean, I think you do. I mean, you said it's optimism. I don't think it's naive. I think it'll be hard. I think that in this market for everybody, agents, business, like people that are building like banks, like you are, Max, like us building the brokerage, it's like walking uphill in sand. And I'll tell you, I get really sick of it a lot of times. But disruption causes opportunity, and I strongly believe that those that muscle through this will come out of it much, much stronger. For agents, I recommend that they follow the same strategy that you're following, Max, and you didn't say it this way. The same strategy I'm following, and that is that you look at cash flow management to start, right? Cash flow management simply means like, can I pay my mortgage? In a worst case scenario, what do I look like? Worst reasonable case scenario, like realistic case scenario, how am I? And so you first look at that and you make sure that you're stable, make sure you have stability, and make sure you don't go out of business. The people that die on the roller coaster are those that jump off. So don't jump off. Don't be forced off the roller coaster. That's number one. Stay in business, stay alive. If you can stay positive enough, stay optimistic enough to work really hard through this and to delight a lot of clients, even though it might take you 2 to 3 times longer to get a deal closed, you will come out of this so much stronger because your work ethic will be much, much stronger, and you've built your SOI in a way that will continue to yield results for you. One of the silver linings, there's not a ton of them, but one of them is that the relationships that you build during hard times are really deep, very lasting relationships that people don't forget. And the habits that you build in any time stick with you. So you will have to build habits. You'll have to not go out of business. In order to not go out of business, you have to build habits that are very effective to make it through this. Those habits will stick with you when the market turns. Those relationships will be with you when the market turns, and you'll make a lot of money. I won't tell my personal story about '08 again, because it's honestly, I've told it too many times. But Max, you and I share very similar stories of like really hating the '08 recession for about 4 years and thinking it was really not an awesome time. And then all of a sudden, like the market turned. I didn't even realize the market had turned because I had just been paying so much attention on my own business and the habits that I'd built. And all of a sudden I was making a ton of money. And I was like, oh my God, this is really, really awesome. So that's what I would tell anybody who's an agent out there, is stick with it. Don't go out of business, and you will ultimately be really happy with yourself a couple of years from now. Way happier than if you go, get a different job or whatever it is.
And I would say the same thing is true for loan officers as well. I mean, you still have loan officers making less money, some making less money than they've ever made, and they've been doing this 15 or 20 years. Now there's the outliers, and you have some loan officers that have builder accounts and they're builder business heavy. And so those guys are having record years, maybe not this year, but 22 and 23, especially 23. You're seeing these guys have record years in a down year, but there's nothing lasts forever. This market has lasted considerably longer than any of us ever expected. 22 came, we figured it was going to be 24, then it was 25. And
I'll tell you what, we had a really long boom run. I mean, I'm not saying we deserve this or anything like that, but
no, I mean, it goes back to 2011. I mean, we had an 11-year boom where everybody was great. Everybody was a genius, could do no right. Turns out like the market was really, really friendly to people that probably didn't deserve it. And a lot of those people are out of the business, they're no longer loan officers, they're no longer real estate agents, but there's still good money to be made in this business on either side of the aisle that you're on, real estate or mortgage. So,
there's some other tactical advice I'd like to offer to agents as well. And that is, demand is still there. Supply is what's in excess, which means the traditional wisdom of going after listings, focus more of your energy on buyers. They are out there, they are buying things.
Disagree with that. I'll totally disagree with that.
I'm sorry?
I will totally disagree with that.
All right.
Focus your activities on business. Focus your activities on meeting people who are interested in talking about real estate. And if they want to sell a house, list their house. And if it takes you 1 month or it takes you 2 years, that's business that you will close. Trying to attack buyers versus sellers, it's just, in my opinion, Aaron, sorry, it's good advice and it's well-intentioned. And certainly buyers are more valuable right now than sellers, just like sellers were more valuable than buyers in 2021. But if you go out there with great intentions to help as many people who want to move as possible, that's where you're going to find success, in my opinion. But it's good tactical advice in terms of like strategizing, like who should you focus your time on once you meet them.
So when you're doing your listings, if you have choices between photographers, maybe invest less in those listings right now. Spend more time doing open houses to pull in buyers. That you don't need to focus on buyers and not focus on listings. Absolutely, take those activities that generate clients that are building relationships. When it comes to how you're deploying your capital and where you're deploying your time, I would recommend going after those buyers, right? Like, I mean, back in a strong seller's market, you weren't spending as much time doing open houses because it was just so hard to work with buyers back then. It doesn't mean you ignored them. It was that you just focused more in your activities on those listings.
No, I agree. And sorry to disagree with you, everyone. It's not really, it's basically that I agree with you that looking at what's the most effective way to win in this market that's definitely the way to go. And I totally agree with you that right now is not the best time to start a massive, expensive postcard farming campaign to sellers with the low ROI. It's probably a better time to do that. So sorry, it's not like, oh, I massively disagree with you. It's just like, hey, there's probably some nuance here.
That's what I love about our friendship.
Me too. I want to thank everybody who's still here. A lot of people hung on. We will post this on YouTube. We'll post it on Spotify. We're going to email everybody that signed up a link to all of it. If you need to get a hold of Aaron, I dropped a link to his website, agentintel.co. I think everybody knows how to get a hold of Max. Everybody knows how to get a hold of me. If not, just Google either one of us and you'll find us pretty easily. And yeah, guys, like keep your chin up. There's a lot of gold to be made. Whenever you look at this as a career and not as a year, that's the perspective you need. And just know that times will get better. And like hard times, like it's weird, but you will look back fondly at them for some weird reason. I don't know why.
Well, it's that old chart, right? Hard times, tough times make tough people. Tough people make weak times. Weak times make weak people.
No, it's tough people make
good times, not weak times.
whatever. I know what you're saying. I know what you're saying.
So, that actually was one of the things that I was going to say. We were talking about rates, and I think when you're in the fives, it's going to get better. I'm doing forward commitments on a new construction project now for a builder where they're doing 4.99 30-year fixed. Like they're buying it down, doing the forward. And those things, I mean, they're selling quite a bit. So to me, it's just like you get rates, fives, great, fours.
We should have lunch and talk about this sometime. Why in the heck does that not work for resale? Because it sure doesn't. And I have no earthly idea why it doesn't.
Because
we can talk about it another time.
I'm still working with attorneys to try to figure that out.
All right. Thank you guys so much. Appreciate everybody that came.
Thanks, y'all.